you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. Someone's sitting in the shade today because someone planted a tree a long time ago. Rule number 1, never lose money. Rule number 2, never forget rule number 1. As one of the richest people in the world, it's no wonder people often ask Buffett for advice. Who wouldn't want to know the secrets of his success over 70 years of investing? One person who has thoroughly studied Buffett's methodology is Mary Buffett. In 7 Secrets to Investing, like Warren Buffett, Sean C. and Mary Buffett reveal their top secrets for building a successful portfolio, just like Warren Buffett. Why building new habits is the first step to success. How to invest in areas where you are competent. Why undervalued companies present great opportunities. Concepts like saving and thrift might seem unappealing, especially in an environment of high inflation. We are in times when it is getting more and more difficult for some to make ends meet. However, it's still important to develop a savings mindset. Without a savings consciousness, it is challenging to build wealth, whether your monthly income is $1,000 or $10,000. When you look at lottery winners, most of them go back to their old ways because they don't develop the habits that allow them to stay rich. This is something that Buffett emphasizes, and it is a habit that must be acquired. Saving is not about accumulating cash in dollars. Buffett is a person who does not like to hold cash unless he is forced to. It is not sensible to invest in something that is already losing value. The point is that you need money to invest money. Saving may not come naturally to all of you, but it is one of the most important secrets to success. That's why you need to make it a consistent and persistent habit. But where should you start? The first step is to set aside 10% of your earnings. Place this money in a separate savings account or somewhere you can't easily access. If saving 10% is tough, try the incremental savings method. Save $10 the first week, $20 the second week, $30 the third week, and continue this way, increasing the amount you save by $10 each week. While it might not seem like much at first, by the end of the year, you'll have saved around $13,780 in total. That's an average of $1,148 per month. These numbers are just an example. You can adjust the logic here according to your income. Whether it's saving or our habits, consistency is key. The way to achieve consistency is to start small. People often get excited by ambitious goals and set big targets, but after a short time, these big goals can feel unattainable. This can be discouraging and might ruin a good habit. However, when you achieve stability and see your savings grow steadily, the habit of saving becomes permanent. What I care about most in saving is automating the deductions. People are naturally lazy, so you need a system that automatically deducts from your earnings every month without relying on your willpower. Spending money is easy. Wealthy people save and grow their money. Let's imagine. We can buy $1 with a 25% discount. So you pay 75 cents and in return they give you $1. How much would you invest? The answer is simple: as much as possible. This situation is unlikely to happen in real life, but if you invest really well, it's not much different from the hypothetical. Sure, some investors rely on speculation, but legends like Warren Buffett follow a proven methodology. They focus on 2 key factors: the intrinsic value of a company and whether its stock price reflects that value. And that's where value investing comes in. Buffett is an investor who literally knows how to value a company. In fact, Buffett learned the value investing technique from Benjamin Graham, who taught value investing at Columbia Business School for years. Many of you have heard of the book, The Intelligent Investor. Benjamin Graham is the author. You might not have years to perfect your investing skills, and that's okay. Here's a quick version. By analyzing the market and studying key figures and reports, you can identify undervalued stocks. In simple terms, this means finding stocks where the company's value is higher than its current stock price. Let's revisit the alternative world we mentioned at the beginning of the video, 25 cents for every dollar. Once you recognize the mismatch between these values, there's a good chance that you've found a company worth investing in. Of course, there are no guarantees in the stock market, but that's the beauty of it. The lack of guarantees can lead to astronomical gains. Some people describe the stock market as part of a capitalist system. On the contrary, if you know the rules of the game, you'll see it's one of the great opportunities available to the middle and lower income groups. Elon Musk, Bezos, none of them will come to you and say, "Let's make you a partner in our company." But the stock market gives you this opportunity. However, if you chase secrets in online chat groups, what we call an opportunity can turn into bankruptcy. Let's get back to our topic. There have been many studies on value investing. This shows that investing in undervalued companies is a powerful strategy. Value investing is certainly a better way to invest than speculating or acting on a gut feeling. However, it is possible that after investing in an undervalued company, the stock you bought may become even more undervalued. This is where another of Buffett's strategies comes in: patience. Often, over time, the true value of the company is realized, and your timely investment will bring you a good return. Suppose you have some money set aside for value investing. With so many companies out there, where should you start? What's your area of interest? It's crucial to ask yourself this question. You're already at a good starting point. Warren Buffett doesn't invest in any business he isn't familiar with. This means he knows what companies offer and how they work, and he can see the value of their products and services. Buffett often uses the term circle of competence. You can create your own circle of competence by asking some basic questions about your interests and sense of success. What field do you work in? Which brands do you like to spend your money on? Are you good at cooking? Or are you proficient in programming? Now, you can create a framework around all these questions and more. This framework should answer these 3 questions. What do I enjoy doing? What am I good at? What do I spend my money on? By going through this exercise, you should be able to identify some industries or types of businesses that fall within your area of competence. This is where you'll start looking for companies to invest in. Buffett's investment strategy isn't just about identifying undervalued companies. He also has a margin of safety against possible losses. He calls this the economic moat. None of us, Buffett included, can see the future. However, we can be certain that there will be plenty of ups and downs along the way. Some businesses offer products or services that have the potential to weather all these bull and bear markets and cultural shifts. This is what makes this possible: the economic moat. Well-known brands are often the best examples of this. For instance, brands like Kleenex, Band-Aid, and Tupperware. Over time, a well-known brand replaces the name of the product. Usually, such companies have an economic moat, and this is how they have withstood all the adversity they have experienced up to the present day. Another crucial aspect to consider: can a company attract customers despite higher prices? Companies that can do this will stay on top for a long time. Examples include Nike, McDonald's, and Burger King. Another measure of the economic moat is related to having a low-cost production model. In other words, can the company continue to make a profit even if it lowers its prices? These companies can beat their competitors with more affordable prices. Amazon is an example of this. Naturally, economic moats aren't guaranteed to last forever. This is especially true in technology. So another question is the company's product or service so dependent on innovation that it cannot survive? One could argue that the iPhone is a good economic moat right now, but its popularity depends on Apple staying ahead of the game. It's certainly possible that in the not-too-distant future, a new and more innovative product will emerge and make the iPhone almost overnight obsolete. We saw a similar situation with Nokia. Although the book gives the impression that Buffett would not invest in Apple, one of the largest shares of Berkshire Hathaway, which Buffett manages, is in Apple. So, Apple's case is a bit unique. The global brand recognition of the iPhone and other Apple products is huge. Let's dive into the technical aspects of value investing, which is crucial for determining the true value of a business. The 5th secret to investing like Warren Buffett is to understand the language of the business. This means learning to read financial statements. Most people give up here, but if you want to make smart Buffett-style investments, don't put off learning this. Let's focus on the basics and review them briefly without delving into too much detail. Imagine you've discovered a company that presents a promising investment opportunity after an initial assessment. We'll call it Giacomo Bicycle. It's crucial to review the 3 main financial statements: the balance sheet, income statement, and cash flow statement. This data can be found through a simple Google search. Let's start with the balance sheet. Here, you can find the true equity of a company, also known as the net worth. By adding up all the company's assets and subtracting all liabilities, including debts, you get the net amount. Focus on the company's debt-to-equity ratio. Let's assume Giacomo Bicycle has $1.3 million in equity and $500,000 in debt, resulting in a debt-to-equity ratio of 38%. This is a reasonable outcome. Typically, it's common to find companies with a debt-to-equity ratio of 100% or even higher. Next, examine the net profit in the income statement. The return on equity, ROE, is crucial here. In 2021, Giacomo's equity was $1 million, and in 2022, it showed a net profit of $520,000, resulting in a 52% ROE. Anything above 15% is considered excellent. At this stage, it's essential to understand what some of the indicators mean. If you prefer not to deal with calculations, you can access this information for free from paid apps or certain bank websites. However, not all indicators may be available in free apps. Finally, review the cash flow statement. This statement reveals how the company manages its money. Is there sufficient cash for daily operations? Is the company paying off its debts? Are shareholders receiving dividends? Essentially, you want to see consistent and positive cash flow each year. Sometimes, businesses make large purchases or experience negative cash flow due to sales cycles. However, generally speaking, it's important to see a positive cash flow history when reviewing past records. Take a deep breath. Analyzing a company's financial statements is certainly not an easy task. I understand that many people may not have made it this far into the video, but this is where you can stand out. The key is knowing what to look for. Even if a company's financial health shows it is profitable, this alone does not mean you should invest. That's why valuation is crucial. A company's balance sheet might look good, but the stock could be overpriced. Tesla is a great car brand, but paying $100,000 for a $50,000 car wouldn't be very wise. Buying stocks at a low price right before they rise is ideal. The key is the net-net method, a type of value investing technique. It was developed by Benjamin Graham, Warren Buffett's teacher, and is the backbone of all value investing. The net-net method involves comparing two data points. The first is the net current asset value, or NCAV, sometimes referred to as the liquidation value. The other data point to compare with NCAV is the net current asset value per share. Let's go back to NCAV, or liquidation value. Liquidation occurs when a company sells everything to pay off its debts. At this point, whatever is left goes to the shareholders, and that's it. NCAV is what's left. This data can be found on the balance sheet. Let's look at Giacomo Bicycle again. The balance sheet shows that the company has $700,000 in assets and $650,000 in liabilities, resulting in an NCAV of $50,000. Now all you need to do is calculate the NCAV per share. Assume this company has 20,000 outstanding shares. Dividing the $50,000 NCAV by 20,000 gives us an NCAV per share of $250. Next, ask yourself, what is the current price per share for this company? Are the shares selling for less than $250? If so, they're undervalued. This is a good sign for a potential investment opportunity. Benjamin Graham believed the best opportunities come with a 33.3% margin of safety, meaning the current price per share should be 1/3 less than the NCAV per share. So, if the shares are selling for around $160 each, it can be considered a good opportunity. After all these calculations, let's move on to something simpler: managing your portfolio. It's important to manage your portfolio wisely and responsibly. Let's start by accepting a simple fact: no one is always right. Therefore, it would be wise to leave room for error when managing a diversified portfolio. So, what happens if everything doesn't go as you predicted? If you lose 50%, you'll need a 100% gain just to break even. Warren Buffett includes many businesses in his portfolio. As he puts it, diversification is protection against ignorance. Here are 5 important rules for portfolio management. Rule 1. First, you need to calculate how much money you will use to start investing and how much you will set aside for future investments. Of course, to achieve this, you need to have nerves of steel and a lot of dedication. In 1969, Buffett withdrew from the investment game for 4 years because he saw that everything was overvalued. So, when the stock market crashed from 1971 to 1974, his money was safe. Rule 2. Never put more than 10% into a single stock. If you don't put all your eggs in one basket, you won't lose all your eggs if the basket falls. Rule 3. Let's say you're interested in 20 companies. Take some time to rank them based on how confident you feel about each one. This will give you a simple strategy. The higher a company's confidence ranking, the more investment it deserves. This way, if the value of this company or companies decreases, you will know exactly what to do. Rule 4. Review your portfolio at least once a year. Look at the annual and quarterly reports published by the companies in your portfolio and make some adjustments if you notice worrying trends. Rule 5. Don't sell just based on price. A good company is more than its stock price. Think of the investment as an employee and ask yourself, would you fire someone just because they had a bad day or week? Even the most successful companies can face significant price drops from time to time. Buffett is more willing to invest when the stock price of a strong company falls. I have shared 7 secrets that can help you make smarter investments without giving specific investment advice. They might not make you a multimillionaire overnight, but they will significantly help you get a good start. Continuing and building on these secrets is up to you. The most important secret is to form good financial habits. One example is developing a savings habit, like setting aside a certain amount of money for investment every week or month. The other secrets are all about value investing, finding undervalued companies and investing in them. Buffett also uses his circle of competence when investing, which makes it easier for him to understand how each company works. Additionally, Buffett invests in companies with an economic moat, which makes him resilient to economic crises. Another crucial strategy is portfolio diversification. In this video, we explored Warren Buffett's 7 key secrets. I highly recommend you also check out this video featuring Robert Kiyosaki's 9 teachings. I'm confident it'll completely transform your perspective on finance. If you're facing financial challenges in your life, it's time to take action. A little effort at first, and the rest will follow naturally.